Hello there, welcome back. We're now looking at the final section of non-current assets. This time we're looking at intangible non-current assets. Now, when we've been looking at non-current assets so far, we've been looking at tangible non-current assets, assets that have physical substance. You can touch them. Remember, they're assets that you can kick. Now, when we're thinking about this idea of intangible assets are assets used in the business on an ongoing basis, but do not have physical substance. Now, usually they're just a bit of paper, okay, giving you the right to something. They do not have physical substance. They do not physically exist. Like I say, usually they're just a bit of paper. Now, when I'm thinking about intangible assets, what am I thinking about? Well, we could have things like goodwill. Now, goodwill arises due to the excellence or reputation of a business. It's intangible because it only arises through the good business relationships and people in the business. So a business would have, yes, they would have physical assets and they'd have cash and receivables and bank, etc. But the value of their business, their worth, is not just their assets. It could also be a bit more. We've built up at LSBF this interactive. We've built up a certain degree of goodwill from you guys buying our courses and being customers to us. Okay, so you as customers enhances our goodwill. I'd like to think that as a lecturer, I contribute towards the goodwill here. Because of my knowledge and my expertise in the field of financial reporting. And again, I contribute to the value of the business. So it's the knowledge, the skills, the customers of the business and the people within the business. That's goodwill. That's the excellence or reputation of the business. You can't touch it, doesn't have physical substance, but it is there, it is an asset. We do get economic benefits from having me lecturing you. Okay, so goodwill could be an example of an intangible asset. Other things that you may be more familiar with, patents, brands or trademarks and copyrights. Again, maybe you purchase a patent to protect an invention that you made, so maybe you created a new design of a product of some kind, and you're protecting that product, so protecting the economic benefits or the right to those economic benefits of that product. That would be an intangible asset. The key thing we need to remember, though, is if you want to recognise an intangible asset in your statement of financial position, well, what you must remember is that can you reliably measure the value of these assets? And the only way really that you can reliably measure the value of these assets is if you've externally purchased them. Okay? So externally purchased or externally generated. Okay? So I can only recognise goodwill in a business if I've acquired another business, acquired all their assets, but also acquired their employees, their staff, their knowledge, their expertise, their list of customers and so forth. That's because I would have paid a bit more than the book value of the assets or the fair value of the assets in the business. Now, the difference between the price that I pay in acquiring that new business and the fair value of their assets and liabilities, well, the difference would be the goodwill. okay, the excellence and the reputation of the business. I can reliably measure that value. But my own goodwill that I've generated in my business cannot be recognised. Why? Because I cannot reliably measure the value. I'm sure you could put a value to it if you really wanted to. We could get a specialist business valuer in to value it, but that's just someone's opinion, isn't it? You know, if you asked another person, their opinion would be different. You can't reliably measure it. The same goes with patents, brands and copyrights. If you've purchased them and you've paid a cost for it, then yes, you can recognise it. But any internally generated titles or customer lists, well again, if it's internally generated, you can't reliably measure it, therefore it cannot be recognised as an intangible asset. So, now we've made that very, very clear, okay, only externally purchased. You have to put a reliable measurement of value to them. Now, the key exception to this is research and development. Now, research and development is an example of an internally generated intangible asset, because you're going to use that development and use that product that you've developed to generate you economic benefits in the future. Okay, the example of an asset, and the definition of an asset. So this is the only exception. Now, research and development is usually a substantial amount of cost to some businesses. For example, pharmaceutical companies spend billions and billions of dollars year on year on just research and development into new products, so new drugs, etc. So it's not something that we can easily ignore. Now, when we think about research and development, this is covered by Accounting Standard number 38, which looks at your intangible assets, but particularly pays attention to research and development. Let's have a look at the definition of research first. Now, when we think about research, it's just the original investigation into products or materials or techniques that we could then use in our development. Let me give you an example. Once I've finished this recording today, I'm going to go to London St Pancras Station in London, and I'm going to get on a train on the way home. Now, I don't know what time I'll finish today, but I know that I'm going to investigate into the train times. And there's a train at 5:30, a train at 6 o'clock, a train at 6:30, a train at 6:45. I've done that research, so once I've done this recording today, I'll go home, I'll go to the train station, knowing full well what different train times are there. I've done my research. Now, just because I've researched into those train times, does that mean for sure that I'm going to get on the 6 o'clock train? Well, no, not necessarily. I might get on the 6:30 train because I might be discussing something with a colleague, or maybe talking to a student that I see on the way out of the building. So just because I research into train times and I think I'm going to get a 6 o'clock train, it doesn't mean that I'm actually going to get it. There's no guarantee at this early stage that I'm going to get that train. Now, bringing this back into research and development, just because I've done some research into maybe the market of the product that I want to develop, or I've done some research into the different types of materials or the different production techniques, it doesn't necessarily mean that I'm going to take that research, use it in a development project turn that development project into an asset if I'm developing a product, and an asset being inventory, and then sell it in the future, it doesn't mean that that's going to happen. There's no expectation or guarantee, should I say, no guarantee at the research phase that I'm going to get that future economic benefit of selling that product that I would have developed and generating income and cash as a result. It's too early to say. So, with research, what we have to effectively do is say, well, if you've spent money on researching, well, that is always going to be an expense in the statement of comprehensive income. So essentially, every time that you spend money on research, it's going to be expensed and written off to the statement of comprehensive income each year. Now, it doesn't matter if then you use that research and actually turn it into a development and then turn it into a product which you'll then sell. So it doesn't matter, regardless of whether you use that research in your development and then into turning it into a product, doesn't matter. Always expensed. You need to remember that. Okay? So research costs always expensed. Now development costs. You're going to develop a product, okay, and you need to incur costs such as maybe doing a prototype. You're going to have lab technicians that are working on this prototype and making these initial designs and tests, etc., on this new product. All of these development costs you're incurring, and they're going to be quite expensive, particularly if you're a large pharmaceuticals company, for example. So, what IAS 38 says is that all these development costs that you incur on a project, well, you can capitalise those costs and show them as an intangible asset in your statement of financial position if, and only if, you meet 6 criteria. Okay? 6 criteria. Here is the 6 criteria. The first criteria is that it must be technically feasible. In other words, your development project must, be technically feasible. In other words, science allows you to do it. Okay? So, I always used to say to my students years ago, oh, well, you wouldn't be able to run a car on water. Okay, that wouldn't be technically feasible. Which, as it turns out now, I've been reliably informed that actually you potentially can. So we'll use something completely different. We'll say it is not technically feasible to run or power a car on Coca-Cola, okay, or any other drink. Okay, so it's not technically feasible to do that. Wouldn't it be great if you could run a car on Coca-Cola? Because you could go to the petrol station, but it'd be the cola filling station, and you'd pump the petrol, but it wouldn't be pumping petrol, it'd be pumping cola, and then you pump it into your car, and then you put the Coca-Cola into the car, and you could sort of do the whole, one for you, one for me, one for you, one for me. It'd be fantastic. But it's not technically feasible. Science would not allow you to do that. So in that case, is it technically feasible? That's something you've got to ask yourself about the product or knowledge that you're developing. Now, our second criteria is their ability to use or sell the product. So if you're developing a product, is there an ability to use that product maybe to improve your productivity and production, Or can you sell that product? Is there a market out there? Do people potentially want this product? So you'd have to do some sort of market research in order to see if you have an ability to use or sell that developed product. The third criteria is probable that future economic benefits will flow to the entity. So once that development is complete and you've turned it into a product, okay, as a result of turning it into a product and selling it, will you get an inflow? Is it going to be likely that you're going to make a profit as a result of developing this product and then selling it or using it internally? Point 4 then, there must be an intention to complete. So there's going to be no or very little risk that we're going to down tools and stop the development halfway through because we feel like it. Management must show an intention to complete that development and see it through to the end. And I suppose linking to that, there also must be resources available to complete. So there's enough cash in order for us to spend that money on the development in order to get it into its production phase. And finally then, point 6, the costs of the development can be reliably measured. So can you reliably measure those costs of your, maybe you've got some PhD students, maybe you've got some lab technicians. Do you have some timesheets to verify those costs? Do you have invoices for the materials that you've used in the development? And so forth. So there's your 6 criteria then. You need to remember that 6 criteria for the exam. To help you do that, I have a little mnemonic. It's called sector. S-E-C-T-O-R. Where the S, is there an ability to sell or use the asset? Is the expenditure measurable? So can you reliably measure the expenditure or the costs? Will it be complete? Okay. Will you complete that development? Is there an intention to complete? T, technically feasible. Okay. Does science allow you to do that development? O, can you demonstrate overall economic benefits from this development? And are there resources available? So are there resources available? Sector. That I hope you remember that 6 criteria. You could get asked about that in the exam. If you meet all 6 of that criteria, your development costs can be capitalised and added to non-current assets in the statement of financial position. Now, we've established then that we can capitalise intangible assets if we externally purchase them, or development costs if they meet that 6 criteria. You're initially going to capitalise them at their original cost, but then we have to have subsequent treatment. Now, just like with tangible non-current assets, we capitalise them at cost and then we depreciate them. Well, we're going to do the same thing with intangibles, capitalise them at cost, but we're going to amortise the cost of those intangible assets over their useful life. And amortisation is just another word for depreciation. amortisation is intangible depreciation. So, when we think about then subsequent treatments, intangible assets are amortised over their useful lives on a systematic basis. If it has an indefinite useful life, so we don't know how long that asset will last for, well then what we do is review it annually for impairment. So we test at the end of each year if that asset needs to be written down in value, if it's become impaired in value. Anyway, with amortisation then, the double entry would be debit amortisation expense in this statement of comprehensive income to reduce down your profits, and credit accumulated amortisation to reduce the value of your asset, your intangible asset, in your statement of financial position. So there you have it, that's intangible assets, and that is the non-current assets section of the syllabus now complete. Thank you.